Tariffs have thrown the global economy a curveball, creating a ripple effect across the financial world. If you're not making smart investment choices today, you risk being left behind. Imagine owning an investment that not only delivers consistent cash flow, but also grows that income year after year, even during market turmoil. Sounds like a dream, right? Well, that's exactly what SCHD, the Schwab US Dividend Equity ETF, aims to provide. But with the recent 2025 reconstitution, major shifts in sector weightings, and the ever-changing economic landscape, is it still a smart move for your portfolio? Introduction. In this video, we're diving deep into SCHD, one of the most popular dividend-focused ETFs in the market. We'll break down its recent changes, discuss why it's made some bold moves this year, and explore whether it's still a reliable choice for long-term investors. We'll cover the latest sector adjustments and what they mean for future returns, how SCHD handles economic challenges like tariffs and rising interest rates, its impressive dividend growth, and why it stands out in the crowded ETF space, expert projections on potential future returns. If you're looking for a balanced income-generating ETF that can weather market storms, or if you're just curious about the latest trends in dividend investing, then this is the video for you. Stick around to the end to get a clear picture of whether SCHD deserves a spot in your portfolio in 2025 and beyond. Let's get started. Chapter 1. What sets SCHD apart? First, what exactly is SCHD? At its core, SCHD is an exchange-traded fund, ETF, designed to track the performance of the Dow Jones US Dividend 100 Index. However, it's not just a random collection of dividend stocks. This index is sharply focused on quality and sustainability. Here's what sets SCHD apart. 1. Strict quality criteria. SCHD doesn't just grab any dividend-paying stock. It filters for companies with solid financial health, focusing on those with robust cash flows, manageable debt, and a healthy return on equity. These companies must demonstrate long-term financial stability and operational efficiency. 2. Dividend growth strategy. SCHD isn't just about immediate income. It targets firms with a strong track record of consistently raising dividends over time, reflecting management's confidence in future earnings. This focus on dividend growth provides a hedge against inflation and market volatility. 3. Long-term reliability. To qualify for SCHD, a company must have a minimum of 10 consecutive years of dividend payments. This stringent requirement filters out high-risk, unproven businesses, emphasizing stability and financial durability, which are crucial in uncertain economic times. With these high standards, SCHD aims to provide investors with a balanced mix of income, stability, and growth potential, a powerful combination in today's unpredictable market. 4. Strong fundamentals and market cap focus. SCHD also prioritizes companies with solid fundamentals and significant market capitalization, ensuring it holds financially robust businesses capable of sustaining dividends even during economic downturns. This approach helps shield investors from unnecessary volatility. 5. Annual rebalancing for quality control. SCHD isn't a static fund. It undergoes a full reconstitution every March, adjusting its holdings to align with changing financial metrics. This annual review removes underperformers and adds promising new dividend players, keeping the fund in line with its long-term objectives. 6. Low cost, high yield. Cost is a critical factor for long-term investors, and SCHD stands out with an ultra-low expense ratio of just 0.06%, making it one of the most cost-effective dividend ETFs available. As of April 2025, it also boasts an attractive dividend yield of around 3.74%, offering a compelling combination of income and growth potential. Chapter 2. The 2025 Reconstitution Strategic Shifts. Now let's examine 2025, a pivotal year for SCHD. The latest reconstitution introduced significant changes, signaling a strategic pivot rather than a mere adjustment. Key changes in SCHD's portfolio. 1. Reduced financial sector exposure. One of the most notable shifts is SCHD decreasing its allocation to financial stocks. This reduction aligns with a cautious approach as interest rate uncertainty looms, and financial companies may face pressure from rising borrowing costs and tightening regulations. 2. Increased energy sector allocation. In contrast, SCHD has significantly ramped up its stake in the energy sector. This move reflects the growing global demand for energy, driven in part by the rapid adoption of AI technologies, which require substantial power. Additionally, geopolitical tensions and energy security concerns are making domestic energy producers more valuable. 3. Boosted consumer staples holdings. SCHD also increased its investment in consumer staples, industries that produce essential goods like food and household items. As unemployment edges up to around 4.1%, defensive sectors like consumer staples become more appealing, given their stability during economic downturns. Why these changes? Impact of tariffs. Recent tariff policies are making US-based consumer giants more competitive, as foreign imports face higher costs. By increasing consumer staples exposure, SCHD is positioning itself to benefit from this shift. Economic adjustments. With rising unemployment and potential slowdowns, SCHD's focus on more resilient, essential sectors like consumer staples makes strategic sense. Technological demands. The rise of AI and machine learning is fueling energy consumption, prompting SCHD to increase its energy sector weight. This proactive move aligns with global trends as industries become more digitally driven. New minimum yield rule. To maintain investor appeal, SCHD has introduced a minimum yield requirement of 2.4%. This rule ensures that only companies offering sustainable dividend payouts remain part of the portfolio, maintaining both quality and income potential. Chapter 3. SCHD's resilience to tariffs. One of SCHD's standout strengths is its ability to handle economic shocks like tariffs. It achieves this through a carefully balanced mix of sectors. Unlike some ETFs that lean heavily on a single industry, SCHD spreads its investments across multiple sectors, including financials, healthcare, consumer staples, energy, and industrials, while keeping its tech exposure relatively low. This diverse blend is intentional. Different sectors respond differently to tariffs. For example, technology and consumer discretionary industries often face significant challenges when trade barriers rise, as they rely heavily on international supply chains. Tariffs can increase production costs and reduce demand, hitting profits hard. However, sectors like consumer staples and healthcare tend to be more resilient during economic turbulence. These industries provide essential goods and services, which people continue to buy even in challenging economic times, making them more stable during tariff shocks. This diversification is what gives SCHD a strategic edge. It doesn't rely too heavily on one sector, reducing its overall risk and making it less vulnerable to sudden economic shifts. For comparison, look at JEPQ, which has a heavy focus on technology. When tariffs target the tech sector, JEPQ can experience sharp declines. In contrast, when recent tariff announcements rattled the market, SCHD only saw a modest dip of about 3.13%, highlighting its more balanced defensive approach. Another key point is that SCHD avoids the Magnificent Seven tech giants like Apple, Microsoft, and other high-growth, high-risk tech stocks. While these companies are market leaders, their reliance on global supply chains can expose them to significant tariff impacts, adding another layer of risk that SCHD strategically sidesteps. Why SCHD stands strong in uncertain times. One of SCHD's key strengths is its ability to remain steady during turbulent market conditions, like those triggered by tariff hikes. This resilience is rooted in its careful stock selection and balanced sector exposure. Let's compare it to another popular dividend ETF, VYM, Vanguard High Dividend Yield ETF. Both funds target companies with a history of paying solid dividends, but there are critical differences in their approach. VYM takes a broader approach, spreading its investments across a wide range of industries. This diversification can help reduce risk, but it also means it might include companies with weaker financials. In contrast, SCHD applies strict selection criteria, focusing on companies with solid financial health, strong cash flow, and a consistent track record of dividend growth. This focus on quality over sheer quantity makes SCHD better positioned to handle tariff-related market volatility. Another critical factor is SCHD's beta, which measures its sensitivity to market movements. With a beta of 0.78, SCHD is less volatile than the broader market. For example, if the overall market drops by 1%, SCHD might only decline by about 0.78%. This lower volatility can be a significant advantage during periods of economic uncertainty, providing a smoother ride for long-term investors. This design means SCHD is built to reduce dramatic price swings, offering more stability during turbulent times. This can be particularly reassuring for investors looking to weather the storm without constantly worrying about sharp market drops. Chapter 4: Long-term performance and future potential. When evaluating the long-term prospects of an ETF like SCHD, it's essential to consider its historical track record and potential future returns. Past performance. Over the past decade, SCHD's generated impressive average annual returns of roughly 11%, demonstrating consistent growth despite market fluctuations. In more recent years, even during periods of heightened volatility, it has managed to deliver around 7% annually, reflecting its resilience in challenging economic environments. Downside protection. A key advantage of SCHD is its performance during market downturns. It has a proven history of outperforming the broader S&P 500 during bear markets, providing a layer of downside protection that many other funds lack. This defensive characteristic makes it particularly appealing to long-term investors seeking stability alongside dividend income. Future growth drivers. Looking ahead, several factors could drive SCHD's returns higher. For instance, if the energy sector continues to gain strength, or if tariff policies support domestic industries, SCHD could potentially achieve annual total returns in the 12 to 15% range. Optimistic scenario assumes favorable economic conditions, strong corporate earnings, and stable dividend growth. Potential risks. However, there are risks to consider. A prolonged global trade dispute or significant supply chain disruptions could negatively impact many of SCHD's core holdings, especially if tariffs reduce demand for American goods. Additionally, rising interest rates could make dividend-paying stocks less attractive, potentially capping SCHD's upside. Overall, SCHD stands out for its historical stability, reliable income, and defensive market positioning, making it a compelling choice for long-term dividend-focused investors. However, staying alert to changing economic conditions remains crucial for managing risk and maximizing returns. Chapter 5: Dividend Growth and Expert Outlook. Consistent dividend increases. One of SCHD's standout features is its track record of steadily increasing dividends over the past 12 years. It has consistently raised its payouts, demonstrating strong financial health and a commitment to rewarding shareholders. As of 2024, its dividend growth rate was over 12%, reflecting both stable earnings and effective management. This means investors benefit from both regular income and compounding growth, creating a powerful long-term wealth-building strategy. Analyst projections. Some market analysts have set optimistic expectations for SCHD moving forward. I've seen projections suggesting potential annual returns of around 14%, assuming favorable economic conditions and continued strength in sectors like energy and consumer staples. However, it's important to approach these estimates cautiously, as market conditions can shift quickly, impacting long-term returns. Balancing risk and reward. While SCHD offers significant upside potential, there are still risks to consider. A global trade conflict, rising interest rates, or a slowdown in corporate earnings could weigh on its performance. Investors should keep these factors in mind when evaluating its long-term prospects. Thanks for staying till the end. Here's to your investing success. Profitable investing.